can I bring up the panelists now? So we're going to introduce the first panel. This is our buy-side panel. We'll do a brief introduction, get going. Again, as they're talking, if you have questions, enter them in on the app. I'll be able to see them. We can also go old school, and you can just throw up your hand. Just brief introductions. Susan Joyce is the head of municipal trading and market structure at Alliance Bernstein. She oversees the development of ABX, AB's proprietary OEMS, in addition to high-grade, high-yield, and taxable trading for the municipal team. James Pruskowski is the chief investment officer and head of global client business at 16 Rock. He oversees investment strategy, portfolio construction, and client engagement. Previously, he was a managing director and global CIO for institutional and wealth management at BlackRock. And Abhishek Lodha is director of strategy and innovation at AG Analytics. He helped spearheaded the company's strategy, product development, news business opportunities, and strategic partnerships. So with that, let's kick off and get going. I want to start with a question about, since we're focused on technology, I want to start with a question about AI. Everybody talks about AI, it's the buzzword. How are you using it at your firms, or if not yet, how are you thinking about it? What are some of the ways you're thinking about how it will be incorporated into your processes?
May I start?
Yes, kick it off.
Yeah, it's a big deal. I mean, obviously, if you want to personalize your approach, differentiate your products, we've all spent years in this market developing expertise and our way of doing things. For one, reason or another, developed significant, presence in Excel or Python code, to really wrap it up, the absolute return generation or alpha generation into your footprint. We're spending a lot of time on trying to figure out the nowcasting part of it.
Okay.
And then how do you package up the absolute alpha part of it, your personal touch to deliver forecasting? And then how do you use AI to really test it out to deliver the performance?
Susan?
Sure. So I think when people talk about AI, they're meaning a lot of different things. So it could be machine learning, natural language processing. And I think that's where the market's a little bit more adapted, where we're using it in some of our client servicing as well as our quantitative development. But I think we're still in the early stages of AI, and I think where the market goes and where it ends up being used, I think that's still something that's evolving. I don't feel like there's any consensus on how that's going to be used in the municipal market as of right now.
Have you incorporated any of that technology into your current systems, or are you looking at that? Or?
We're exploring it. It's a part of how we look at some of our quantitative models in terms of machine learning, but I wouldn't say that we are completely AI focused right now.
Yeah, a lot of our focus at AG Analytics has been on the credit side, just because we feel that that's one of the more underserved needs. So I agree with what you just said, right? AI is, I remember joking with Matt, right? It's like the last episode of Sopranos, right? Everyone talks about it, but no one gets it.
Nobody dies
Yeah.
Okay.
And it's important to demystify it to a great extent. Where we focus a lot is content generation, right? So if you think about AI, there's content or data generation, and then there's data inference, right? How do you understand and derive patterns from it? A big value that we're seeing, to your point, it's very hard to form patterns, especially in a fragmented market, unless you have a lot of data to be able to train these models. So the first thing where we're using NLP and machine learning is a lot on the data generation, right? Like if you think about munis, 50,000 issuers, hundreds of thousands of issues, each of them has OS documents, audits, continuing disclosures. How do you scrape this in a more efficient way so that the data is there that you can then analyze and find patterns? This is where we're trying to focus a lot on.
Is there any initial learnings you have from that, or any observations? Is it working or not working? Or?
I think this goes back to, like, you have to find a really narrow subset to start your modeling, right? You have 100, 150 different sectors. I think where we see a lot more success would be in plain vanilla sectors where we're still learning, but I think there's a little more success, and that's at AGA and my previous jobs as well. So plain geos, where credit analytics is a little more structured. We're doing a lot in certain states like Texas and California, where disclosure are a little more standardized. So that's where you see a little more success than you'd see in state of New Jersey, where credit disclosures are completely different.
Susan, we were talking about separately managed accounts out in the over the coffee before we came in, you were talking about the growth of the market, the complexity of it. So it's there's opportunity in customization, but just also challenges, right? So could you talk about that a little bit, how you deal with those and what you see, where you see that going, maybe in a growth sense and in sort of how technology can help you manage some of that complexity?
Yeah, I think what we've noticed is the drive towards customization. So our clients, they want something that is tailored for their specific needs, for their state, for their, how much they want to be doing tax loss management and all of those different factors. And so being able to offer a suite of just interchangeable pieces of how they can look at an account and set that up easily, that's where a lot of our focus has been recently. And that allows us to manage right now we have 24,000 SMA accounts roughly, and we have to target what's in the market at any given point in time, and how do we do that in a way so that we're getting invested quickly if we're making changes or doing tax loss management, that we can do that across all of our accounts in a way that is streamlined and also fair to every account that's involved. And you need data. You mentioned that starts with data. It always starts with data, like having good access to all of that data. That's where we started. And then going from there to how do you distill what is the right bond for a particular account. So that's also where we're focusing on is pre-allocating. So everything that we're investing in, or for the most part, what we're doing is we're pre-allocating and we're assigning where a particular bond meets a client's needs and optimizing against that.
You said, I think you told me a large percentage of you said 60 billion you manage is in SMAs right now, right?
Right.
How's that grown, and where do you see that growth going?
Right, so roughly half of our assets are in SMA, and I think we've seen a good amount of growth in the last couple of years, even with the market troubles that we've had here. And I think that only increases. I think clients want that customization. They want that individual focus for their own personal needs and not just one product that needs to fit everyone.
Is there any technology gap you see right now in terms of, you're thinking this is what we need, or this is a gap in the market?
I mean, I think in general, it would be great to see more buy side doing more on the smaller odd lot trading and the different, where I think providing liquidity, we're providing a lot of liquidity into the market there, but then I think you also need the buy side, the sell side, the algo shops, everyone needs to be involved in in that market. So,
James, any thoughts?
Got distracted by my phone, sorry.
I like that whistle thing, whatever that was.
Yeah, the whole automation of SMA and just the asset management business is an enormous deal. I mean, all the way, from the start of onboarding an account. I mean, you need to make it a comfortable and a very efficient, smooth process. And then from there, the whole customization. How do you optimize portfolios? How do you manage all these line items? How do you reduce expenses with those line items in terms of getting the data from your technology providers? And then how do you efficiently access the technology platforms just in terms of execution, not just the over-the-counter market in terms of Bloomberg. And all of this is really to better run risk management. And ultimately, given the fee compression that's going on in the industry, drive down costs.
Anything particular on the data that you're talking about accessing the data that's you see challenging right now? What are people struggling with?
I think it's all out there. It's mapped in very unique ways, and I think the market is primed for disruption. It looks a lot like the mortgage market.
Oh, really? Yeah.
Very similar in terms of how you can map it by cohort, MSA region. The challenge is obviously the cost of the data.
Yep.
You guys know that very well. And really to put your stamp on things and to package it all up and what you do with it.
What's it cost?
I think to your point, data is all available. It's just not accessible, right? I think that's the big part of it. It's not stitched together in a way. I mean, when you talk to a data scientist anywhere, he'd be like, I spend more time cleansing and bringing the data together than actually analyzing it, right? And that's the first problem of those three that we're talking about, right? You have data, getting all the data centralized in one place, then running analytics, to your point, so that you can make good informed decisions. And the third is workflow. How do you do this seamlessly without having to swivel between different platforms, right? Because you spend so much time in a free compressed world, just going between different applications becomes a huge issue. I do, from a trading perspective, I think my peers here really covered it well. One of our big focuses, again, talking to your odd lot point, is smaller credits, right? Asset managers, just by function of overhead, are not able to efficiently look at them because who's going to open a POS or an audit to look at a 2 million, 5 million issue where I'm going to get maybe like 500 bonds, right? But if you can start bringing that data in more efficiently, be able to either credit score it, build triaging models, build any sort of decision trees, it makes that process a lot more seamless without adding that added effort or workload on your research team. And that hopefully leads, again, to your point, better liquidity in the market.
Next question I had was on muni ETFs. I'll just stick with you for now, like your thoughts on that. I mean, obviously, the ETFs have changed equities and corporates and everything. How do you see them as affecting, managers? Are they an opportunity? Are they a threat? Like, how does that? What's your thoughts on that?
So I'm not a trader or portfolio manager, so I wouldn't comment in terms of market dynamics there. But I think from a technology and data perspective, it's the same challenge, right? How do you create an efficient, scalable cohort across all these credits? So there's definitely a lot of interest now. One of the challenges we're seeing, and I think you mentioned it as well, is this linking of CUSIPs to sectors properly, right, or obligor, so that you can do that efficient portfolio allocation and breakdowns. And we're seeing a lot of engagement from a lot of buy-side clients who are trying to build something better out there so that they can essentially create their portfolios in a more scalable and robust way.
Yeah, it's cannibalizing the industry.
I appreciate the honesty there.
Probably, in the end, in a very good way. But God, if you've built your franchise around a mutual fund or a closed-end fund, good luck, and don't have ETFs. It's funny that you drive down these costs at 2 basis points, but now you're delivering, active ETFs at 35 basis points. So, many ways to skin a cat to get the revenue that you once had with a mutual fund as flows here shift. It's ultimately adding transparency and liquidity to the market, vis-a-vis, given the growth of MUB, for example, you could trade big lots, both long and on the short side. But we'll see how it transpires. I think it's fabulous change, but one to probably create a lot of bumpy roads as we go through.
And sorry, I don't mean to cut you off, but to James' point, right, that's why it's ripe for technology as a market, right? If you're an SMA manager or a traditional mutual fund, you can't compete with them just, without technology and just by human resources. So how do you find that man-machine symbiosis to form an efficient solution that you can deliver to your customers is going to be absolutely critical.
You mentioned active muni ETF. So we launched our first one a year ago. So we just hit our 1-year mark. And it's been an interesting way to approach the market structure. It's just a different way of accessing liquidity. And so far, it's been educational, I think. I think muni ETFs, they have to have their place in the market. I think for a lot of clients, they're going to be an efficient way of transferring and moving risk around. But I also think that in periods of extreme stress, they can amplify volatility.
That's a good point.
We're getting some questions coming in. I appreciate that. I forgot to say one thing is we're going to award the best question with a Spline Data T-shirt.
Wow.
Not just any T-shirt, but it's a Carhartt branded, made in Vietnam T-shirt. There's some kind of weirdness about that, but so all the questions are anonymous, but we'll vote on it afterwards. I'll announce it at the next panel. Okay,
Nice.
But a couple of questions coming in. This is directed at Susan. The question was, how often does Alliance Bernstein change its information sources for research and market data?
As you can probably imagine, when you make a decision to add or remove data, that takes time. It can be kind of sticky. We review everything periodically. I wouldn't say that there's like a set time frame, but we are always evaluating if something is meeting our needs or if we have a gap in our data. We don't pretend to do everything internally, and external data sources are a part of that as well.
I don't know if anybody else wants to tackle that, but next question, this I think might go to you, is what do you see are some of the unique sources of data or automation in the muni space that aren't serviced by big data, capital B and D, and execution providers? So what else is out there?
I'll speak mainly from the credit side again. So I wouldn't call it unique, but there's a lot of data that credit research analysts look at within, again, these PDF documents, right? Maybe legal covenants information or information about, especially with what's happening in the last year, right? Climate change and adaptation efforts that issuers are taking on. Finding all that structured data and sourcing that has been a big challenge in our market. There are litigation issues that we're seeing that need to be addressed. So a lot of that data needs to be extracted and analyzed. I think that's one big thing. We all know, ESG is now a bad word, I guess. We're not going to use it as much.
Only at BlackRock.
Yeah, only at BlackRock. Or once BlackRock says it's a bad word, it's just a taboo at that
Everybody
point.
else is okay.
Yeah, I think there's a lot of climate risk in alternative data. Like there was a fun example we were talking about just yesterday. Population migration is so hard to measure, just given the fact that you have census as a data source, which is 12 months lagging. Yeah. But there is a data set that we're working with where you either use MasterCard transactions or cell phone transactions and then extrapolate that to find population migration. Yes, it may be like more short-lived and like maybe temporary, but at the same time, it may be giving some realistic idea on where revenue forecasts for these credits are going. So people are starting to consider that. Again, like I wouldn't say there's something very universal. It's again, certain data sets work very well in certain cohorts of the market. And this again adds to that pressure, right? I can't bring in all these 150 different data sets and build my own data lake because it's overwhelming. But which is where again technology has a lot of potential for us to build it and create a SaaS-based solution.
That's got to be the future, right? Though some of those kind of location data.
Yeah, by far. You have an industry built around tax codes.
Exactly.
And states, obviously, and you have very viable sectors. If you could map, especially MSAs in the demographic areas, and really create brilliant products around funding rural areas that are undercapitalized, that meet the needs of whoever's passion, and do it with climate scoring or various risks related to that. I think you could really create a different industry that looks a lot different than it historically has.
I don't really
You don't have to answer that. Okay. We'll come. The next one might be for you. Do you have concerns SMA managers will be disintermediated by technology for simple strategies like high quality ladders? If anyone wants to take that.
I don't know about disintermediated. I think SMA managers, they continue to be a product that works for a lot of clients. Ladders are a part of that as well. I think that if you are not investing in technology and data, you're going to fall behind.
I put it in perspective. A lot of these big wirehouses that are doing big mutual fund businesses, we don't have to mention names, just started providing SMA products all but 8 to 10 years ago. And now you have model portfolios and managed accounts, all these new flavors, and you're finally giving access to individuals within this market that want to invest $500,000, not many millions. So to me, it's still in its growth stage.
Had another question about AI. We asked a little bit about that in terms of what technology you're using, but the question was, how do you see AI utilized in money management and trading 2, 5, or 10 years from now? That's a lot of perspective, but any thoughts about how it will change your business?
Take it first.
I think anything that is being developed, new quantitative methods, whether that's AI or anything else that we're looking at, they have to be integrated into your trading strategy. You can't ignore this. And do I think it's going to happen next year? I don't. But I think that there will be a place for it for a lot of managers of money.
I think you'd almost have like an AI. We're seeing that now, right? It's almost like having a research assistant to yourself.
Yep.
I don't know about 10 years. I mean, 2 years ago, no one was talking about Gen AI, and here we are, right? So the exponential spike in terms of what traditional AI and then now large language models are doing. So things could change. I'm not an expert there, but yes, I think it's really going to enable. And this goes back to your comment earlier, right? Every company is now a technology company. So it's part of you have to have a strategy around how you integrate technology. It's not a back office function anymore. It's a core business enabler. And if you don't think of it that way, to your point, you're going to be left behind. And part of that is having an AI strategy.
Do you think there's anything different about munis versus other financial sectors, corporates, equities? Is AI going to be used in similar ways, or is there anything unique to munis you think where AI can help?
I mean, I can't speak specifically AI, but in terms of data analysis, it's a big numbers problem, right? You have 1 million CUSIP, you have 50,000 issuers, and that requires you to have more complex models around data, I think.
And the challenge, sorry, go ahead, James.
No, I mean, obviously the profit's got to be there. So, heavy, significant retail presence, large amount of data, I think it's something that's just not discussed enough. I think there's firms out there that have been working under the radar, jumping from equities now into munis, given the arbitrage associated with the P&L. So, it's amazing. I mean, I've been doing this a long time, but the amount of stuff you learn over the last 6 months of who's doing what and why they're doing it and how they're doing it and how it's going to set up for disruption is there's a lot going on.
Can you say more? We can name names if you have to or want to, but just say a little bit more about what you mean by it's disruptive. What's being disrupted?
I think it's it's the whole mapping, whether you're on the credit side or on the alpha side. Like I said before, looking relative to the mortgage market, everything fits into a nice cohort, and how you map the data and what flavor and formula you want to put on it is up to you. But it's really mapping and getting the ongoing disclosure that's a big deal, that you could put a proprietary model type based approach on it. And then at the end of the day, it's the differentiator. If you could drive performance out of it, flows follow performance. So.
Yeah, no, that's been the biggest problem, right? Like the cost of doing, you have this fragmented market. The cost of actually standardizing it is so high that the profits start to dwindle, or the profitability starts to dwindle. At that point, you question, do you even want to do that? And a lot of firms end up investing in humans because of that, instead of thinking long term and building out core good infrastructure and technology to be able to scale themselves up in the long run. So yeah, I think that's.
No, it's scary too. You could have built out a huge AI investment pre-generative AI. They basically got wiped out.
Yep.
I mean, was now.
I mean, to me, the AI term is used pretty loosely. So, I think a lot of the models now are, mostly regression based. Again, nowcasting. That will play a very important part to the forecasting. And the nowcasting part of it, there's, 4 firms going about it in different ways, and I think there'll be one winner. But the forecasting is definitely the next leg of it, and what you do with that.
The next one was for Susan again. For Susan, what analytics do you use to calculate bond-specific attributes, spreads, durations, and so forth?
Why don't you get me at the cocktail hour?
You're very popular. Okay.
I'm not going to go into the specifics of the model on the record.
Okay. I don't know if you want to tackle that or have any thoughts or.
No.
Okay. So whoever asked that, you know where to go at coffee hour.
And you get the T-shirt.
And no, yeah, probably, yeah. Okay, when thinking of pain points, how do you think of the lives of credit analysts will be improved with the use of AI? This was for you. That's.
Yeah, definitely for me. I think one of my colleagues asked that question.
I like you out him. That's good.
Yeah,
okay.
I gave them specific instructions. I think it's really enablement. That's what I want to think at. I feel credit analysts in most places, the way we kind of think about them are storytellers, right? They're there to kind of convince your clients and give them a story on what you're trying to invest in and why you should be. And that takes a lot of time. Like you're looking at so much, I mean, it's crazy. Like a 300-page OS to find litigation issues or any sort of climate issues was mind-boggling when I saw that with a bunch of analysts. So I think that enablement to be able to look at this data in a more efficient way and not feeling like you're replaced, and B, your quality can potentially improve is a big part of this. And that's where we want to focus on. I mean, on average, any credit analyst at most SMAs or larger institutional shops are looking at 200 to 500 credits, right? So that's hundreds of credits versus their corporate counterparts who look at a few. Yes, the risk is lower, but the amount of data and information to scour through is the same, and it's less quantitative in a lot of ways, right? So how do you take this subjectivity and make it a little more structured and objective is really where they'll see a lot of benefit in data extraction and standardization.
Have you seen any like examples of that are promising so far?
Yes, not going to take names again on record, but yes, there are certain firms who've seen on the asset management side, either they've been able to double or triple their assets without adding analysts while the quality remains the same. And there are places where you see significant efficiencies in just terms of the amount of time it takes to do like underwrite the credit without actually having to skip any steps that you may want. So there have been benefits, and we're hoping we can like scale that and do that more with a lot more beta or like testers in this market.
It's interesting. In my former life in the news business, I thought about that a lot. Like if you covered Chicago and Florida, and like how do you synthesize all that information, which is unstructured information? And there's so many inputs that are not hard data. Like
cutting through the noise, right? Like that's been a big challenge in our space. Yep.
I think it's an opportunity, though, I guess is what it says.
And you have those examples on the corporate side, right? Like smart research assistant tools, which help you just scour through all this information overload. And how do you do that in a more succinct, systematic way for analysts is going to be a huge value proposition for the market.
And I think to your point about partnering, right? So we have a credit analyst who's working with our internal data science team on figuring out exactly like scanning those OSs and pulling the information out. And she doesn't have a technology background, but she understands credit, and so she's working with the data science team that does understand the
technical part. Yeah, exactly. Yeah. And that's a good point. I think that's I would love to highlight that point a little more. Is yes, now teams have changed. It's not traders, PMs, credit analysts, and then IT in the back, right? That's not
it's woven in?
Yes,
or what,
you saw that with quant traders making it on the floor, and now you're seeing that with data scientists. And I think you form a more tech-enabled group, which includes technologists along with your subject matter experts, because both those pieces together is really going to empower companies.
So they're like sitting on the floor now, or they're right there?
They should. I don't.
Okay.
Yeah. We keep our data scientists in a crate, but
like they're in New Jersey or where are they?
Yeah, somewhere. Yeah.
Okay,
No, I'm just kidding. But yeah, like I think that collaboration is extremely
probably
critical.
safer.
That's a big part of what we've done with our tech is that we're really collaborating really closely with our developers. Talking to them all the time. I know I am. And on our trading team, of the three of us, two of us have technology backgrounds, including myself. And I think that ability to move between, we have people who are in tech who want to move into more on the business side, and then we have the reverse happening as well.
That's great.
To me, it's the whole theme is you've automated and outsourced your back office that's now moving to the front office. The whole technology angle of it, as well as just things like outsourced portfolio management, where someone with a bigger brand puts their promotion around something. To me, sadly enough, I do see a lot less credit analysts out there, given the mapping and capabilities of what you could do. Given that the approach has typically been reading reports and news that's already been published, rather than how do you get ahead of it, and then how do you preserve the nature of the approach just by utilizing the advancements by the average deal size of munis is 30 million. So there's a heck of a lot of issuers that fall under the radar that you could really differentiate yourself, not just focus on big deals, big issuers.
So this is an outlier question I like. What are the chances we see a quantitative rating agency pop up as a result of the credit data becoming standardized?
Wow.
Would you use it? Obviously, the rating agencies are very
That gets the T-shirt.
But I think so. I like that. I appreciate the outlier nature of it, but
Yeah.
I have thoughts about, I guess you could even expand it, thoughts about rating agencies in general. And I don't know.
You know, they're paid by the issuer. So, you know, that's one problem. And, you know, similar to today's trend where pre-reads don't have ratings and the NAIC scores them as a high yield bond. And, you know, many clients are forced to sell them. So, you know, having, I don't know, I have a hard time processing the question just in terms of, you know, you got the ESG scoring or rating that is, you know, everyone has their own different flavor of it. So it's probably going to take a long time.
Everything requires adoption by, you know, the market has to use it, and if they think it's valuable and if they think it provides information, like perhaps, but
Right.
I think it's hard to break into that space.
Yeah.
Most firms kind of do that internally, right? Like you just develop an alternative credit scoring model, for example, just because, again, I mean, just from number one, it's like, you know, 17 ratings, right? But people want to be more bifurcated and create more nuances on their credit scoring side because, hey, not all triple Bs are the same. They're going to score differently and be able to find those.
Right.
That triaging and rank stacking is very important to a lot of firms. So people are doing that. Would we come to a standardization? It's, which again then becomes the same question, right? Okay, that's another standardized data provider then, like a rating agency, right? So after a point, do you still want that? You know, is a question mark. But yeah, I feel like that internal adoption, if data is more and more easily available and accessible, people are just going to build their own models and continue on that path.
Yeah, well, eventually BlackRock will sell it to all of us and something maybe. Here's a more of a fundamental question. Muni yields continue to press higher. How are accounts laddering their portfolios given the bifurcated thoughts on rates? Which I don't know, our poll said 70-30, so I'm not sure it's super, but any takers on that?
Laddering their portfolio for higher rates, so guarding against higher rate shocks?
I guess they're saying muni yields are going higher. How are accounts laddering their portfolios given, you know, different views on rates, let's say that.
Oh, I'll take the other side that they're going lower.
I do too. I think they're going lower, but I have to buy a house, so that's why.
You know, it's you got to position your portfolio to hit a lot of singles. You know, no one wants to. You know, Derek Jeter got in the Hall of Fame with what, a 300 batting average. So, you know, you're not gonna win every one of them, and you have to basically position your portfolio with a tactical and a strategic outlook, and a strategy. So, you know, part of that is buying rate protection, just the diversification vis-a-vis the yield curve or couponing and credit. And then looking at volatility and the analytics and correlations to figure out, well, you know, what beats more or less. And then if you have the ability to utilize leverage and hedging and all those other good things, then, you know, it adds a whole new mix of it. You know, I take the other side just because I look at 2023 as the great reset. You know, compensation compression, large layoffs, budgets that blew up because of the war on junior talent. And very similar to 2008, this crisis is coming out with an investment in technology and outsourcing. And it just means lower for longer. You know, I view the world as a race to zero, similar to what Japan did.
It's cheery, optimistic. Any thoughts? Or?
I mean, I think that for anyone who is looking at overall yields, like this should look like an opportunity, an entry point, but I think there's nervousness. You know, we saw the numbers, like there's no consensus on where rates are necessarily going to go, and I think that you see retail in particular sitting on the sidelines, just trying to figure out if there's going to be any certainty. Of course, once there is a move, that might be too late.
Right.
But
I think we have to jump on one more, and this one's an outlier, I like it. What is your minimum hiring criteria for new junior experienced hires? Maybe speaks to you more on talent, but I don't know.
Me?
is someone looking for a job?
Okay, and it's anonymous, so that's identify yourself.
I don't know. You gotta be hungry. You gotta have a passion. You gotta have the wherewithal. You definitely need to know how to code.
Oh, interesting. What do you say more about that? Like, what do you mean exactly?
You got to know enough to be dangerous. You know, we're all dealing with a large amount of data. You know, and it's beyond Visual Basic. Python is almost the core necessity these days. I started my career in '94 and, as a self-taught coder, and it was trying to figure out how to dumb down a lot of information in a very simple form so a portfolio manager can digest. And, early on turning into a chart boy and, helping get answers really quickly. So you got to be hungry and you got to have the skill.
Do you think the people you're seeing applying have those skills coming out of schools or coming younger people, or?
Yeah, I think it's forced on them. I'm certainly, I got a lot of kids and I'm certainly forcing it on them. It's all over the map still, and you get a variety of talent, but you could really curl it to what you want. And there's enough out there.
I don't think everyone needs to code. I think everyone needs to be able to talk to technologists and understand how coding can be used in order to design something. But I actually think that as you see things like ChatGPT being able to do kind of building blocks of coding, that you no longer need to be able to do exactly every single piece of, like I code, but not everyone on my team does. But everyone on my team, I'm expecting them to be able to work with technology, to be able to understand what the limitations would be, the cost of what they're asking for, and to be able to have that back and forth. So, but maybe we all need to code.
Yeah, for me, Python is the new Excel kind of a thing at times. Yes, to your point, yes, not everyone needs to code. I think it's almost like understanding the basic logic of how technology works, right? Like it's being maybe a little bit more technology literate. I don't know if that's the right way to put it, but in a world where information is so democratized and easily available, you can learn things quickly. So to your point, passion, you need to be able to learn and adapt quickly is very important as an attitude. Know a little bit more about technology and how it's going to be built. I think like we think of, and most places where I've worked at, like, business teams, stakeholders come in and like, oh, I want this to be built. And then you wait 6 months and then realize you've gone over budget, right? You've not delivered enough and you've completely shot up that project. And that happens at many places. And that's because this goes back to senior stakeholders need to understand how adoption works, right? How do you start small, make POCs, kind of build on top of that? So you want to see that mindset, not just from like junior, employees who are just starting their careers, and especially, no one trains to be a Muni person, right? There's no degree for that.
Nobody dreams of being a Muni person? Come on.
Yeah. I grew up in India thinking that I'd be a Muni bond analyst at one point. It would be a fun story. But I think to be able to, just understand how adoption can work and make the company tech-enabled is a top-down, mindset we need to have across the board. And I think that's happening a lot more, right? For us to have this panel, for people to be more tech-enabled out here who are from the business is very powerful to see.
No, I think that's right, because a lot of what we're doing this day is really talking about technology and how that's changing in the industry. And I think a conference a few years ago would have been all fundamentals, right? So that's a sign of the times. With that, we're going to call the first panel. I want to thank the panelists.
Thank you.
And we have